Hi, it's Stephen here. Buy-to-let property and stocks are two of the most popular investments in the UK. Over time, they've made investors a lot of money. But which one are going to give you the better returns over the long term? For me personally, I've always chosen property as my investing vehicle. This is because I just didn't like to try and work out which stock to pick that would actually make me any money. Property just resonated more with me because I could actually go out there and see it and touch it, and generally real estate value increases over time. However, the stock market attracts millions of investors and some people claim to make millions from it. And here again, timing the market rather than timing the market is a simple strategy to follow. With the recent big gains seen in some stocks and crypto, I've been thinking more about the potential of investing in the stock market and the risks associated with doing that in order to get another more passive income stream. So I thought it's about time I looked into the returns I could get from the stock market and comparing that amount of money invested into real estate over time and understand the pros and cons of each. If you've been thinking about what's a better investment, you're going to get a lot from this video as I explore what is the better investment, stocks or property. When you buy stocks, you're buying a tiny piece of that company. You can make money in two ways with stocks: value appreciation as the stock price increases and through dividends. When you buy real estate, you acquire land or property. And most investors make money by collecting rents on that property as a steady income stream and also through value appreciation of that property over time. Property can be leveraged, so it's possible to grow your property portfolio even if you cannot afford to pay cash for the entire property. You just need cash for the deposit amount, and remember to smash the like button and subscribe to my YouTube channel if you haven't already. We can learn from the past to help us determine what might happen in the future, but it's no guarantee. For example, if we look at the FTSE 100 over the last 20 years, it's performed pretty badly. There's a couple of things that really impacted the FTSE 100 is the dot-com bubble that happened between 2000 and 2002, and then we also had the global financial crisis in 2008 and 2009, which really eroded any profits at that point. So what we learn here is we can't rely just on the FTSE 100 and invest in that particular index. We need to further diversify our investments away from just investing in the FTSE 100. So if we compare the FTSE 100 versus the FTSE 250 over the last 20 years, we can see that the FTSE 250 has actually performed better than the FTSE 100. The FTSE 250 has actually doubled over that time, and therefore if we'd have had our investments in the FTSE 250, we'd have doubled our money over the last 20 years. Then if we were to further diversify our investments and then look abroad and look at the US market and the S&P 500, which is the top 500 companies that are in the US on the New York Stock Exchange, we can see then that this index has actually gone up 3 times over that period of time in that 20 years. Meaning if we'd have just invested in that one particular S&P 500 index, we'd have then trebled our money over the 20-year period. As a comparison, let's have a quick look at the property in England and see how that's compared over the last 20 years. We can see, looking at all property types, that in the year 2000 the average house price was £75,000, and then over the next 20 years that has increased to £260,000. So we can see over time the value of that property has essentially gone up. Again, like the stock market, in 2008, 2009 we had a price correction on property, which meant that values actually went down over that period of time. And again, this is just England. You're going to get variations by different county, by different area. So again, it depends where you're investing again as to how much that your property value may go up over time. So looking at historical data on stocks and property, we can essentially tell that the stock market can be quite volatile. This volatility can be a major risk if you're just trying to time the market rather than actually just spend time in the market. The other big risk with stocks is that they can easily be manipulated. As we've seen in the recent history, it's been manipulated by Reddit users and also by Robinhood stopping trades based on certain stocks like GameStop. So then when I compare the biggest risks on property, the biggest risk that I see with property is, as long as you're buying a structural sound property, the biggest risk then is just comes down to bad tenants. So let's just have a quick look at the pros and cons then of stocks versus property, just so we can get a clear vision in our mind about which way we might want to go. So with stocks then, they're easy to buy and sell. You can simply just go into the app or onto the internet and just click the buy button once you've set up an account, and then you bought those stocks. And the same with selling, you just click the sell button and then you've got access to the cash from that sale and you've got that money to do what you want with. With stocks, you've got low transaction fees when comparing to property, with the transaction fees you've got there, it runs into the thousands. In stocks, it's a small amount of money. Investing just in an index fund can be extremely passive. You just invest in, say, the S&P 500 or the FTSE 250, and you just kind of set and forget that. You just buy and hold it for the long term. You don't have to do anything during the days, weeks, months and years. You can just forget that and look at the statements as they roll in annually or monthly, and there's nothing left for you to do. And the great thing that we have here in the UK is that we can invest in a stocks and shares ISA, which means that any capital gain or income is tax-free as long as it's within that 20,000 a year threshold. So the cons then when we look at stocks is that it's pretty volatile. You don't want to be trying to time the market, you don't want to be stock picking. That type of thing can lead to you being really stressed out, worrying about money all the time, and you're probably looking at the app, you know, all the time to say how's the stock market performing, which is volatile. There is, as we've seen with GameStop in the last week, it can be up and then it's down again the next week, and so, you know, that's a big concern if you just want to be, you know, in the market for a short amount of time. You got that volatility to worry about. The other big con is that you've kind of got buyer manipulation within the stock market. People drive stock prices up, they can drive stock prices down by selling off loads of stock. It doesn't always relate to how well that company's performing, whether they're good or bad. Their stock price can still be falling even though they're making good profit. So it's not an exact science how to invest, and people manipulate the market. The other big con with investing in the stock market is that there's simply too much choice. For me, I want to kind of keep things basic and simple, and that's why I'll probably just invest in an index fund rather than trying to pick particular stocks and, you know, work out which stocks are going to perform better than others. So when we come to property pros and cons, the biggest pro with property is that we've got a rental income. We've kind of got this passive, semi-passive income, this rental income that you're going to be getting every month as long as you've got a tenant in place. Properties generally appreciate in value over time, and this has been proven. If you look at the data over any length of time, property prices have generally always gone up over a long period of time. The other big benefit of properties is that you can actually leverage property. Therefore, you don't need to have all of your cash to buy a property. You can just have a deposit and use that amount of cash to enable you to leverage and get into property, and therefore your money is leveraged a lot more and you're getting an appreciation on the total sum, not just on your small deposit that you might have put down. So the cons then with property compared to stocks is that you actually need more cash to be able to go and invest in a property. Purchasing a property takes a lot more time and effort compared to buying stocks. With a property, it can typically take 3 to 6 months for you to acquire that property and go through all the solicitors and the legals and the agents and the offers and things like that to get all completed. And that's a typical time frame in the UK. In the US, where I've also bought properties in the past, amazingly, you can buy a property over there in 30 days. So in the US, it could be a bit quicker. Another con in property is you've got a lot more aggravation because you're going to have tenants in there. You're going to have potentially hassles with either the tenants, hassles with maintenance of the property, agents maybe. So therefore, you know, you're going to get more hassle with property when you're comparing it to how much hassle you could get with stocks. Also, it's going to be quite slow for you to gain access to your cash that's tied up within your property because you've got to sell it, which takes time. Again, it could be 3 to 6 months. In the UK, you can sell via auction, which would give you access to that cash a lot quicker, but therefore you might not get as high a price for it at auction as you would if you just let it go on the market and take your chances that way. With property, you've also got other fees to be thinking about, and these are a lot more expensive than stocks because you've got things like stamp duty, you've got legal fees and agents' commission fees when you're selling that property. When you make a sale on that property, you're also going to get taxed on any capital gain that you've made from your investment property. So now let's look at what's going to give us the better returns against stocks or property. So if we take a time period of 10 years and we take £30,000 that we want to invest into stocks and into property, what kind of returns can we expect to get? So if we look at the index fund, the FTSE 250, and we invested £30,000 in the index 250, that has typically generated an 8.3% return. That's going to generate us £66,589 over a 10-year period. Alternatively, if we'd have invested our £30,000 into the S&P 500, over the last 10 years, that has generated a 13.65% annualized return, and therefore would have generated us £107,375 over that 10-year period. So then I thought, let's have a look at a couple of property markets in the UK, and I picked Maidenhead and Birmingham as an example. So if we invested in Maidenhead and bought a property in Maidenhead with our £30,000, put that down as a deposit, so then we put our £30,000 into a property costing £310,000 in Maidenhead, that property over the last 10 years is now worth £500,000. So that's generated £190,000 in equity over that 10-year period. We've also generated some rent that we've received minus the expenses, but we don't know how much that is, so I'm not going to discuss that, but there is a potential of profit there between the rent received and the expenses on that property. But also, as we've been owning that property for 10 years, we've been paying down a principal and interest loan, and we've been building up some equity on that property. So our loan would have been £280,000 on this property purchase, and we've been paying that down over 10 years at a 2.29% interest rate on a 25-year loan, leaves us with a balance of around £188,000. So therefore we've made equity of £92,000 there. So then we add up those two together, the £190,000 plus the £92,000, and we're left with £282,000 as our total return on our £30,000 investment on that particular property. Then looking at the Birmingham property market, if we'd have taken our same £30,000 and bought a property in Birmingham that was valued at £131,000 back then, with a £30,000 deposit, that property then 10 years on would be worth £197,000, which gives us a £66,000 equity appreciation in that property. Again, we'll have rent and expenses, but I'm not going to go into how much that would be because we just don't know. But we've also been paying down a principal and interest loan on that property at the same terms of the 25-year term at 2.29%. That one would have started off at £101,000 and would be paid down over 10 years to £67,000, which gives us an equity of £34,000, which then leaves us our £66,000 plus our £34,000, which means we've made a total return on our investment of £30,000 being £100,000. So as you can see, it depends which market you might invest property in. Birmingham compared to the S&P 500 is kind of giving a similar return, and the S&P 500 would have been totally passive. You could just set it and forget it, don't need to worry about it, whereas the Birmingham one, you've got tenant hassles and things like that. There is other ways you can make money on property as well, which you could renovate that property, or you could also increase rent over that period of 10 years as well, and therefore you'd be making a bit more money on those two things. So as you can see, with property, it really does matter which area you buy into, because that can really affect the amount of money that you make on capital appreciation. There's been a big difference in Maidenhead property market and the Birmingham property market over the last 10 years. But with property, you get more hassle, you got tenants, property agents, maintenance worries. With investing stocks in an index fund, it's totally passive, you've got no hassles. So if you want a totally passive investment, I recommend going for stocks. If you're not fussed about getting involved a bit more in your investment and you want maybe a bit of a better return, I recommend going for property. But if you don't have $30,000 right now to invest in property and you're a complete beginner, but you want to start investing, I recommend investing in an index fund like the S&P 500, using a stocks and shares ISA, because you can get up to $20,000 tax-free per year, and that's a great way to start making some money. This is exactly what I plan to do with my own money, and invest in a stocks and shares ISA, and hopefully invest up to $20,000 a year, which would be £1,666 per month. And then if we think that we take a typical return of say 8%, over a 10-year period, that investment is going to be worth £302,000. This is exactly what I'm going to be doing by investing 20 grand a year in a stocks and shares ISA. I'm looking at using Interactive Investor as their stocks and shares ISA. It costs $9.99 a month. And if you're interested in checking them out, I'm going to drop a link below and you can go and check them out and see what they're all about. Thanks so much for watching. I really do appreciate it. If you've watched it all the way through and you've enjoyed it, please remember to subscribe to my YouTube channel and smash the like button. Feel free to follow me on Instagram and see what I'm up to over there, and I'll see you next time.